Hello friends. Last week in my video, I raised concerns about rising crude oil prices and that definitely worried the bulls. In this week's video, I want to talk about when the markets will start rising and what is occupying the top of the mind recall worries of the bulls. And there is a special segment at the end of this video, so do stay with me till the end. Right now, let's dive right into the statistical analysis that you know me so well for. On your screen right now is the market roundup window, which tells you that it was the banking space which led the way down yet again, whereas the broader base Nifty 50 lost a little less. The US dollar index, the Dixie, continued to rise, and so did the pressure on commodities, and you have gold and silver coming down due to a strong dollar. Oil and gas continued to buck the strength in the US dollar, and this is something that we have discussed since the last 3 weeks now. I've told you this is the hurricane season and there are supply side constraints because crude output has been cut by Russia and Saudi Arabia. And now there is a talk about a strike by workers in Australia at a LNG plant that could basically take out 10% of the global supply of natural gas. The USD INR fell 8 basis points. That means the Indian rupee strengthened a little against the dollar. The Indian 10-year benchmark bond yield fell 1 basis point. And once the news of the RBI policy announcement is out, bond markets are now likely to go about with business as usual. NSE market capitalization went up by a little under 1/5%, which tells you that the fall was in index heavyweight frontline counters, whereas the broader market still continued to latch on to fond hope. MWPL or market wide position limits rose a little under 3.5%, and that is along routine lines. Where the US markets are concerned, the headline Dow Jones Industrial Average rose, whereas the Nasdaq and S&P 500 fell. Friends, the market roundup done. I now come to the in-house indicators, starting with the market-wide position limits. Now, these are nothing but limits utilized by traders as against the total percentage allowed by SEBI. Now, this is a good indicator of risk appetite prevalent in the market. And what you are seeing is since the last 5 expiries in a row, the post-expiry lows are progressively higher. And after the expiry, the buildup of market-wide position limits are rising rapidly. What we have seen last week is MWPL scaling up to 38.07%, which is the highest in the last 20 weeks covered in this chart. The probability of further upsides cannot be ruled out because we are just halfway through the derivative cycle, and MWPL normally tends to rise till the week before the expiry. So risk appetite remains alive and kicking in the market. Friends, I now come to the stock and index futures turnover of a 20-week time frame, and this is the total weekly turnover. Do remember these are concurrent 3 series in a row, so August, September and October. Turnover has slipped a little. Not very surprising because the market was relatively range bound with a somewhat of a downward or a weak bias. So during times of weakness, traders do tend to pull back a little and reduce their turnover, which is along expected lines. Friends, I now come to the NSE advanced decline ratio. This is the average of all 5 trading sessions during the week. And what we've seen is the Nifty lost 0.45% as compared to 0.66% in the prior week. So the decline has been somewhat smaller. But the advanced decline ratio has fallen to 0.93 versus 1.25 in the prior week. That tells you that for every 100 losing stocks, there were only 93 gaining stocks last week. That means the intraday traders or one marshmallow traders lacked the buying conviction to push markets higher significantly. Now, this is expected because during times of weakness, the advanced decline ratio itself, being a leading indicator, does tend to slip a bit. Friends, I now come to the Nifty and Bank Nifty basis of the prompt month futures. Now, basis is nothing but the premium or discount prevalent in the futures vis-a-vis the spot price. What you are seeing is that basis of both the indices went up, with the Bank Nifty basis more than double last week. That tells you that at lower levels there was short covering. And short covering, as I have been writing on my social media accounts, is cushioning declines. Now, as long as these declines continue to get cushioned, you can see that bulls still have some hope of reviving the market. So do keep watching the basis. I update this every day on my social media accounts, particularly the Telegram channel, which is free, and this is where we put most of our output. Friends, I now come to our exclusive in-house indicator, the impetus, which you've trusted for more than 2 years now. And the impetus for both the Nifty and the Bank Nifty is registering losses, which means the declines last week across the indices was not really forceful. Otherwise, the impetus would have been significantly higher. So this was more of a slide rather than a sell-off as of now. Friends, I now come to another exclusive in-house indicator that you won't find anywhere in the public domain, the Lift Weight Thrust Drag Index. This is a weekly chart. The daily chart of this index is something I update on our social media accounts. Now, the Nifty has surrendered 0.45% in the week gone by, which is a little less than what was lost in the prior week. But the LWTD has actually come into positive zone last week at 0.35 as compared to negative in the prior week of minus 0.08. What it tells me is that at lower levels, short covering support will be relatively better in the coming week as compared to the week gone by. Now, do remember what I told you from the basis. The basis has jumped, which indicates short covering. So in the coming week, this short covering is likely to persist, which by itself is a good thing. Friends, our in-house indicators done. I now come to the bond markets, and we have been leading the pack where analysis of the bond market is concerned. And we've been telling our online family that it is this asset class that funds or fuels or finances the other asset class markets. Now, this is the third week in a row that bond yields have stayed firm. That tells you that the implication for the market is that bond markets are now sort of living with the idea that interest rates are likely to stay elevated for longer periods than previously expected. Now, the bond yields are still in a no man's land because neither are they going above the 7.60 level where I would start laddering again, nor are they falling below the 6.95 or 7%, below which I would go into gilt funds. So I'm still waiting and watching in the sidelines to deploy checks as soon as some meaningful level is reached. I assure you I'll update what I'm doing in the fixed income market on our Telegram channel. Friends, the bond market's done. I now come to the Bank Nifty, which took it on the chin and fell more than the Nifty 50. The daily chart on your screen shows that the Bank Nifty fell 1.52% and logged losses on 4 out of 5 trading sessions. The price has stayed below its month-long moving average. That tells you that the short-term outlook is also under pressure. The critical support of the previous swing high of 44,152 is the immediate support level to watch out for. What we are seeing is a rough and ready head and shoulder pattern on the daily chart on your screen. I've marked both the shoulders with the head and the red neckline as a horizontal line. So do note that the head and shoulder pattern is usually a fairly accurate and predictive indicator, and it tells you that in the near term weakness is likely. Also do note that the weekly chart on your screen is indicating three consecutive bearish candles in a row, and for 3 weeks now we have seen a slide. Now this is called three black crows formation in Japanese candlesticks, and it has bearish implications unless follow-up buying comes and lifts up prices. The price is still above its 25-week moving average, which means the medium-term outlook remains positive. But for now, if this average is violated, like the daily chart average has been violated, medium-term bulls might also come under pressure. Relatively speaking, the Bank Nifty is looking weaker than the Nifty 50. If the price remains below the 44,121 level, which is the low made by the week gone by, further downsides are not ruled out. Friends, in the week before last, this index was number 4 on the most volatile counters list as per statistical beta rankings that we maintain in-house. It rose by 1 notch to number 3. Not surprising, this index was under pressure and it made relatively large price moves with high intraday volatility, so the ranking has increased. Last week, I advocated an expected range between 46,025 on the upside and 43,750 on the downside, which held perfectly well. In the coming week, I anticipate a range between 45,350 on the upside and 43,050 on the downside. Friends, the Bank Nifty done. I come to the Nifty 50, which fell 0.45% last week. And as the daily chart on the screen tells you, it fell on 3 out of 5 trading sessions, which is slightly better than the Bank Nifty, and the price has now closed below the month-long moving average, which means the short-term outlook has turned marginally weak. The price is showing lower tops formations, and that is a mild concern here. Should the previous swing low of 19,296, which was made on 3rd of August 2023, should that low be violated, downsides may accelerate. Let's take a look at the weekly chart, and the weekly chart shows 3 consecutive weeks of decline due to 3 red candles. Here again, what you are seeing is 3 black crows formation. And do note, 4 weeks ago, what we have seen is an inverted bullish hammer, which is a Nagareboshi formation. By itself, it does not have negative connotations or implications, but follow-up selling in the 3 weeks later have told us that the top of the Nifty is established and activated at 20,000 levels. Now we need to go above this if the bulls are to come back in the driver's seat. The price remains above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook remains positive for now. I would watch the 18,887 level, which is a previous swing high made on 1st of December 2022. And that might act as a support in the coming few days. Friends, in the week before last, this index was number 10 on our most volatile list based on statistical beta rankings that we maintain in-house. It fell 2 notches to number 2 because relatively speaking, the Nifty made smaller intraday ranges. Last week, I advocated an estimated range between 19,900 on the upside and 19,125 on the downside, which held perfectly well. In the coming week, I anticipate ranges between 19,800 on the upside and 19,050 on the downside. I would suggest trading light because of the uncertainty in the market. And do note, it's a shorter week. 15th of August is Independence Day and the market will be closed for trade. Friends, I now come to the retail risk appetite by the virtue of the turnover contribution from various segments of the futures and options series. What we are seeing is index futures, which I indicate by a blue line, fell by 0.01%. Stock futures, which I have indicated as a red line, their contribution again fell by 0.01%. Index options turnover, which I have indicated as a green army green line, also fell by 0.01%. And stock options contribution, which is shown as a violet or a purple line, went up by 0.03%. Now, the absolutely small numbers in terms of change tells you that traders were waiting for the next guy to make the first move before throwing their hat into the market. This is definitely not a sign of an aggressive or a violent or a vibrant bull market. Here, wait and watch seems to be the kind of signal that I was getting from the market. Just as a musician can come to know that his musical instrument is out of tune and he starts to tweak it, a statistical trader will know when his statistical trading model tells him that things are not appearing right based on the weight of evidence. And the weight of evidence so far is telling me that bulls are basically treading water or waiting for the right time before they can come. In this segment that I promised you, I would add in this week's video about what is worrying the bulls. Let me tell you what worries them and when the markets will start rising again. Rising oil and gas prices is something that I alerted you a fortnight ago. I told you that these were the factors that the bulls will watch. Last week, I told you that oil prices is something that might worry the bulls. Bond yields were, as it is, on weighing on the traders' mind along with a weakening rupee. So these are worries that haven't gone away. And what we saw last week is the Saudi and Russian oil output cuts have resulted in oil prices going up, and they gained traction after the Australian workers threatened to go on strike and jeopardize approximately 10% of global supply of natural gas. If you add Nigeria LNG, which declared a force majeure in October last year, and has indicated that it is extending the force majeure. By force majeure mean inability to fulfill its contract of delivery. You know that oil and gas markets are likely to be jittery, and these are basically inflationary indicators. The second worry that is haunting the bulls is that indications or fears are rising again that interest rates are likely to stay higher for longer, and inflation and raw material costs are likely to eat into corporate profits in the months ahead. If you were to actually watch the falling prices of aluminium and copper, now these are two metals, especially copper, which is called Dr. Copper because it is a barometer of industrial activity in the world. You would know that traders are basically betting or punting that global economic activity might just come down a little. It was indicated by a leading shipping company, Maersk, which basically said the consignments and the global shipments are coming down very rapidly and global trade would get impacted negatively. The third is fears of escalation of the Russia-Ukraine conflict or war especially after Ukraine attacked a Russian ship with its drone. Now, both these nations have been bombing each other pretty heavily, and they are both heavyweight commodities exporters, especially food. Now, if food disruptions are to prolong themselves, which means food inflation can rise up sharply from here. Do understand how wheat and rice prices are at multi-year highs. Now, this is another factor that can worry the bulls. So, when can markets actually start rising? When most of these worries, if not all, subside. That is when I would say that the bulls will come back into the act and push the markets higher. Friends, I now share my own thoughts on my trading blueprint in the week ahead. I will continue to monitor banks. I have been telling you PSUs, and amongst PSUs, which is public sector units, amongst the PSU pack, PSBs or public sector banks would be the best bet. And lo and behold, what I have been telling you for 3 or 4 weeks in a row now is coming true. Public sector undertaking shares are really giving traders a lot of opportunities both ways, buy and sell. And PSBs, public sector banks, are also making large price moves in either direction. So a trader will want volatility, and he's getting it in this segment. Watch stocks of oil and gas companies, because both these commodities are buzzing on commodity exchanges, and therefore prices will make large moves. There again, traders will get ample trading opportunities. In the commodity space, I don't rule out further upside in oil and gas prices due to fears of supply constraints and even supply shocks. Do remember what I've been telling you, the hurricane season, which is on since July till October in the US, is historically a time when oil and gas prices are cyclically higher, because drilling and transportation activities might get disrupted due to hurricanes. In the coming week, I would particularly trade light, irrespective of any asset class that I'm trading, because it is a shorter week. And I would keep short stop losses diligently in place, because shocks from large price moves on thin volumes can be especially nasty. Friends, I come to the most popular segment of this video for the statistically minded trader who basically monitors the change in impetus of stocks. I give you 5 stocks which gained the most amount of impetus on Friday, so you trade small quantities with the large price moves expected, and 5 stocks that have lost the most amount of impetus that you trade with big exposure, wait for small price moves. These are for scalpers. The direction itself will be determined by the snapquote window, so I'm just giving you the candidates. Direction the market will decide. Now, impetus gainers list is led by Trent, followed by Z and India Cements, Asian Paints and AU Bank. The impetus losers list is led by IDFC First Bank, followed by Escorts, Indian Oil Corporation, NTPC and IDFC. Friends, this list is valid only for Monday, Tuesday through Friday. I update it only on our free Telegram channel. Do take the trouble of joining this free channel and help yourself get better trading ideas. Friends, I would love to know how my videos are helping you improve your trading performance in the comment segment. Please let me know what you think of our work, and subscribe to our YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Help me reach out to fellow like-minded investors and traders like yourselves by sharing my video with your family and friends. I thank you for your patience and sticking around with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Bye-bye. And a very happy Independence Day in advance. Jai Hind.